Hey, everybody. Welcome to episode 2 of Sharpe Minds. I am your host, Michael Lafata. And even though it's only our second episode, we have a rock star of a guest on the show today. I've been listening to and learning from him for a few years now, and I've grown to admire the way that he views the markets. I love the way he thinks about taking risk, and the way he blends discussions around investment strategy with financial education is really, really special. Overall, I try to listen to him every time he's on TV and other media outlets, when his team puts out research or insights, and having him here is extra special today. With that being said, I'd like to introduce our guest, Brian Levitt. Brian, thank you for taking time out of your day to be here with us today. We greatly appreciate it.
Yeah, it's my pleasure. And that introduction sounded a little bit like AM radio, first time caller, long time listener. So I appreciate that.
That's exactly what I'm going for. Let me give you a little bit more of a background and a proper intro, and then we'll dive into a couple things. So Brian Levitt is a global market strategist at Invesco. In this role, you're responsible for the development and communication of the firm's investment outlooks and insights for North America. You author Invesco's Compelling Wealth Management Conversations, which is a program that helps investors manage their emotions and stick to their investment plans. And I think even cooler than that, you've also authored the firm's financial literacy program, which is something that I'd love to discuss a little further. This program works extensively with families to educate on personal finance. Prior to Invesco, you were at Oppenheimer and spent some time at Morgan Stanley until you ultimately joined Invesco in 2019 when Oppenheimer became part of that family. You frequently appear on CNBC, CNN, Bloomberg TV, and Yahoo Finance, and now the Sharpe Minds podcast. We can add to that bio.
Absolutely.
Yeah. So, first thing I would love to touch on, and I glanced over a little bit, is that financial literacy program. I think that's super cool. You don't, I have, a couple friends that do, similar stuff, but you don't, really hear about that much, in terms of, like market strategists and, super, these big time roles really playing a role in a program like that. So I'd love to hear more about how you're involved in that, what that looks like, and, how you got started in a program like that.
Yeah, I've always thought that asset allocation, macroeconomics, all of that matters, of course. But I think the industry needs to take a larger step back. And so, a couple of things that we had identified is one, for people that have money and are investing, they struggle to keep their emotions in check and they allow different things to kind of challenge them from staying within an investment plan. But even taking a giant step back before that, we realized that not enough people in this country or really this world are talking about money. It's something in our society that is seen as not really being in good taste to talk about money. So we end up not speaking to our parents about it, our friends about it, our children about it. And what we wanted to do was demystify it. I mean, let's put it out on the table. What are we trying to accomplish? What's the purpose of the money? Why do we work so hard? And how do we think about saving it, accumulating it, protecting it, and at some point distributing it?
Right, right. Is there a specific target demographic that you guys try to target with that, or is it, just pretty broad in its nature?
It's largely broad. I mean, it's really for anyone who hasn't spent a lot of time thinking about finance.
Right.
I guess in my mind, I consider the younger generation those that are coming up and are going to have to take on make big decisions over time. But
Right.
it's also for the spouse who isn't involved. It's for and that's both at um, you know millennial Gen X and baby boomer generations. There's plenty of spouses who are not involved in those decisions and would be better served if they had a good baseline to think about it and understood ultimately what we're trying to accomplish. I use the word demystify already. It's not that hard. We have a tendency to overcomplicate it, or people think uh, that it's too difficult to get their arms around, and it's really not. I think Warren Buffett was the one who said you just kind of need to know basic mathematics and you have a pretty good shot of understanding it. So that's ultimately what we try to do is demystify, simplify it, and show some really interesting charts or historical analysis to help get people to say, you know what, I never really knew that. I never thought about it that way. Really just have some light bulbs go off in people's minds.
Oh, that's awesome. That's something I certainly, understand well. I love educating individuals, right? As a financial planner, something I really enjoy is the educational piece of it. So when I learned that you're involved in the program, that's certainly something I wanted to explore more, and definitely learn about. I just think
And
that's super,
what
super
I
cool.
like about it, I'd love to hear what you do with it too. What I like
Yeah.
about it is, I mean, you can really use some real life examples to try and change behavior. I mean, I like to show people say they can't save money. I love to just start off and show them all the things that they probably waste money on. And that's, you could just show them this nominal fee. Okay, you spend 18 to 20% of your personal income on these things. All right, but I don't even think they realize the opportunity cost of it. And I love to teach opportunity costs in
Yep.
terms of what are you missing out on? What could you use this money for? Now that we're no longer in a zero rate environment, how could you compound income at the bank? Or maybe you want to step out in the risk profile and earn some higher interest in high yield bonds or move out to equities and really talk about what that looks like, what that would have looked like over time. You can get some pretty eye-popping numbers based on simply what people probably waste in a given year.
Right. No, and I think that's great. Something that really sticks with me, and the main reason that I got interested into finance when I was young, is just the basic understanding of what stock ownership is, right? Owning a company, right? When I was younger, I went to my dad and, basically asked him what a stock was, and understanding that I could have partial ownership of a company, whatever the company may be, I thought was the coolest thing.
It is.
Yeah. So, being able to portray that message, right? That's something that I really enjoy doing. When you build a portfolio for a client, just telling them that, look, understand the market's gonna have fluctuations. We're gonna have cycles. We're gonna have booms and bust. But at the end of the day, you predominantly own, the best companies in the world. And that's like, you own them. You're a part owner of the company. That's super cool to me.
As far as I can tell, there's really hasn't been a better way to compound wealth
Right.
than to have ownership in a lot of these great companies.
Yep.
Really is.
100%.
I mean, one of the great wealth compounding instruments that mankind has ever known.
100, I couldn't agree more. Awesome. So let's take a step and discuss your role at Invesco, outside of this program, your day to day, what you spend your time doing, and then dive a little bit into some more stuff about Invesco that everybody might not know. I know we often see commercials about their products circled around innovation, and stuff like that, but would love to hear what's some other facts that people should know about Invesco. What are they pretty heavily based in retail? Would love to hear about that.
Invesco is nearly a $2 trillion asset management company with businesses with locations around the world, headquartered in Atlanta. I am here in New York, and we have a very robust and broad product offering across most strategies, most types of investments that you could think of, with multiple different ways to access them through different investment wrappers like ETFs or mutual funds or separately managed accounts, private markets, et cetera. And so we really think of it as, how can we help investors meet their goals based on what they're trying to accomplish? So I spend a lot of my time working with investment professionals who serve clients, and that's across multiple channels. You're right, retail, mom and pop investors is a big part of it, but as well as institutions and sovereign wealth funds and different entities that are going to invest. And when we work with financial professionals, we work with their clients. We really try, and my job is to help you connect with your clients? How can we demystify all of the junk that we hear all the time? How can we overcome a lot of the myths and misperceptions and biases that we have? My colleagues help investment professionals with their businesses, and how can we build businesses that are going to stand the test of time? And the third part is probably what most people know me for, which is thinking about markets, thinking about portfolios. We call it optimizing portfolios. What does the macro backdrop look like? What does policy look like? And based on it, how should we think about what market leadership is going to look like, both in the fixed income and equity places here and around the world?
And so, do you have a tilt? Do you tilt towards the equity side or the fixed income side, or is it a combination of both?
It's a combination of both.
Yep.
We always start with the macro. We start with the business cycle, take a look at what we think the direction of the economy is most likely to be, and how the policymakers are going to respond. And as a result of that, assess historically what that has meant for the different parts of the equity market and what that has meant for the different parts of the fixed income market.
Gotcha. Okay. Awesome. So when you put these strategies together, when you relay the message, you start from macro and build it out from there. Where do you gather a lot of your data from? Are you listening to companies' earning calls? You just getting a lot of economic data out there? What is your primary source of gathering information, putting it together, and then how are you ultimately developing that strategy or the thought process for how investors should move forward?
Yeah, a lot of it has to do with understanding what type of framework you want to use to assess markets. And so when I say where are we in the cycle, there's things that I like to look at. Is there too much leverage or excess in the economy? Is there too much policy tightening? Our corporate borrowing costs jumping. I mean, these are types of things that you can get from government agencies that put out that data. So it is available on the internet, although I largely grab it off of a Bloomberg terminal.
Yep.
But I think those are quite expensive for most people. So, but that's how we get the data. And then directionally, what are your favorite leading indicators for the economy? Usually, that's more survey data, and we're lucky in this country that there's a lot of survey data produced, whether it's the Institute for Supply Management surveying people in the manufacturing sector, whether it's the NFIB surveying the National Federation of Independent Businesses surveying small businesses, et cetera. So usually the survey data can give you a pretty good sense of the direction of the economy. With regards to monetary policy, you listen to the Fed officials, you take it with a grain of salt, but you look at what you believe are leading indicators for inflation. So I bring it all together. Now, don't get me wrong, I'm reading opinion pieces all day long. I'm listening to things like Bloomberg Surveillance and CNBC Squawk Box. And, I enjoy that type of banter, but it largely comes down to what framework do I want to use and how can I be consistent in updating the data and assessing what it means to me each time a new piece of data is released.
Gotcha. So one thing you touched on real quick that I thought was super interesting, was you mentioned listening to Fed presidents speak. Do you think we pay too much attention to not just how often they speak, but the specific words that are coming out of their mouths? Right? People. You go from one meeting to the next. Oh, Powell didn't say this word in this meeting, but he did say it last meeting, or he changed it. And like, do you think we're putting way too much, credence in that?
It might be overkill. I do believe that investors probably don't want to fight the Fed. And so if you remember in 2022, we had a tough year for markets. Why? Because inflation was rocketing up and we knew the Federal Reserve was going to have to raise rates. Why have markets been better over the last couple of years? Because inflation has come down and we knew that the Fed was going to shift their approach. So the direction of policy matters. One of the first things you learn in this industry is don't fight the Fed. And I agree with that completely. Do we put too much into every word they say and every appearance? Yeah, of course we do. I mean, look, we probably, I don't know, do we need 18-hour, 20-hour a day business news networks or any
Right.
news
Right.
networks, right?
Right.
Probably not. But when you program, I mean, there's demand for it. So the public says we need it, so there's demand for it. So you're looking for stories, and when somebody of that importance speaks, you report it, and the markets may adjust. But think about where we are now. We all agree the Fed's going to be easing, right? Do I care which meeting and by how much, or do I care that over the next year the Fed's likely to bring interest rates back to neutral, whatever we define neutral be? That's what I care about. I don't care that somebody coughs standing next to somebody
Right.
else who, right? That doesn't matter to me nearly as much as the media might have you believe it matters.
Right. I totally agree with that. And most likely by this time next year, rates will be lower than they are today, right? At least, that's the suggestion. However, if we see them pause, right, and cut in from cutting, for the most likely cut this month, but let's say, start of next year, they pause, for a month or two. That's certainly going to have an effect on the equity markets, and I would assume the markets won't like that. Even though at the end we might still end up in the same spot, right? So
I
it's
think
it. Go
yeah,
ahead.
a way to say that is markets don't love policy uncertainty. And when there's
Yeah.
policy uncertainty, you tend to get a little bit of volatility in the markets. So if the market's priced for a Fed funds rate of 3.5 by the end of the year, and it has to recalibrate to 4.25 or 4, then yeah, you may have a little bit of retracement in what you've seen in recent equity gains. But that comes back to my earlier thought, which is I have a sense of ultimately where we're going. The path of travel is not of huge importance to me, maybe on a weekly or perhaps even monthly basis, but not ultimately. And look, when you just live through 2022 and the Fed's tightening, and the smartest minds on Wall Street are telling you the terminal rate is 7% or 8%, this is never going to end. You feel much better when you're in an easing mode. So that's where we are now. And I would ask you, or I would ask your clients, ultimately, what would you prefer? Would you prefer weaker growth and more rate cuts? Or would you prefer a Fed that says, you know what, things are pretty good. Why are we cutting so quickly? Even if that trips up markets for a few days, ultimately, that's a better macro picture for corporate
100%.
earnings.
100%. And before the Fed started raising interest rates, we were telling clients, there's only so much yield you can get, right? With rates where they were, there's only so much we can do. There's only so many options available. We're in such a better environment today, right? You have companies that are in a great position to deal with where rates are today. You have individuals who can take advantage of those rates, earn more money on their cash. You have people earning more money than ever before. You have unemployment still at a pretty good level. It just it's what do you think about the whole Goldilocks, right? Scenario that people talk about. It's a term that gets thrown around a lot, but it kind of does make sense, right? It does seem like everything really is trending in the right direction. I know you can peel the layers back and really dig deep and find some things that could possibly show some cracks, but overall, right, it does seem like this is a great environment to be an investor. It's a great environment for companies to do well. And then we haven't even discussed how the new administration might play into that. But overall, it just seems like it is going forward. I guess that Goldilocks situation, even though I don't really want to use that term.
Well, at least you didn't say platinum locks, or if you want to scale it back, go with silver or bronze locks.
Yep.
Yeah, the porridge is pretty tasty. It's a resilient economic environment, maybe better than resilient economy, and inflation is very much back in the Fed's comfort zone. So if that's not Goldilocks, then I don't know what it is. We look at things like the misery index. The misery index is the unemployment rate plus the inflation rate. You could understand how when those things are going up, you're feeling pretty miserable. And right now, you add those two together, what if inflation's two something, the unemployment rate's low four, that's a historically low misery index. That's in essence the Goldilocks scenario. Now, what trips that up is if you have a reacceleration of inflation and the Fed has to kill the cycle. That seems like a very low probability to me. People remember the inflation challenge we have. I'll argue till the end of time that that was the result of the pandemic, and isn't coming back. The growth side is the more interesting one because when the Fed raises interest rates as much as they did, typically something breaks in the economy. Now, the reason nothing broke in the economy right now is, to your point, we weren't over levered. Businesses locked in low rates,
Yep.
households locked in low rates. So most of us, you have a fixed rate mortgage?
I have no mortgage.
Okay, good for you. So I have a fixed rate mortgage.
Yeah.
You don't notice it. The effective mortgage rate in this country is historically low, even though if you go out to get a mortgage today, I don't know what it is, 7% or
Right.
whatever, the effective mortgage rate's 4.
Right.
It just hasn't impacted most Americans. So the Fed was able to break inflation and growth remains good. Yeah, I mean, call it Goldilocks, call it whatever you want. Um, the equity market is certainly enthused by it.
Yeah. And let me clarify that in case that came off, in the wrong way.
You
I
paid off your home
rent.
already?
No, I rent. That's why I have no mortgage. Um,
You
just
know
for
what?
some
Renting's not
clarification.
always. I hope you took that down payment and put it in these markets over the last two
Oh
years.
man, no, it's been great. You know, so how does that all of that come together to how you think markets could proceed going forward? I know if you look at PE, you can argue that market's pretty expensive from a PE point of view, right? You look at the median stock, you can say it's pretty expensive. You look at some of the companies that in 2022, some of these high flyers didn't earn a lot of money or basically had no profits. Huge pullbacks. Some of them were down 80, 90%. Now they're up, way off those lows and, expensive from many standpoints. You have sort of the Mag 7, which, from, many valuations are expensive. How do can take taking that in consideration, how do you consider or how do you think, markets could perform going forward?
Valuations are not timing tools. And so just because something is expensive doesn't mean it doesn't stay expensive, or just because something is cheap doesn't mean it doesn't stay cheap. In fact, most of the time, the broad market is either trading expensive to average or cheap to average. People will throw around the price earnings multiple of 17 or 18, whatever time frame they're looking at, and say that's average. It's actually pretty rare that you're at average. Now, you're right. If you take the 500 names in the S&P 500 and market cap weight them, you end up with heavy concentration at the top, something like a
Right.
third of the indexes in a handful of names. And the valuations on those stocks are above the average by a considerable amount. Now, the reality is a lot of those companies have rallied quite a bit, and actually their valuations haven't even gone up all that much, largely because they've delivered on the denominator. So if your price goes up a lot, but your earnings go up a lot, your valuations don't even move. What is that all about? That's the market pricing in future growth. The markets, I'll pay up now so I can be involved. You talk about owning parts of businesses. All right, do you want to own some of the Mag 7 for the next 10, 15, 20 years? If you do, you got to pay up a little bit for it now, but you're essentially saying these companies are going to continue to grow. The other 492 or 93, trading not necessarily at extreme valuations. If you look at an equal weight index, that's where every name in the S&P 500 gets a 0.2% weighting.
Mhm.
That index is trading at about average valuation. So it just gives you a sense of how top heavy it is. So I'm not overly concerned about valuations. What I think we want to be watching for as investors is catalysts for the other
Right.
493 to do
Right.
well. Now that the Mag 7 have invested so much in AI, will they deliver? Or will we see a period of time where their earnings growth differential to the rest of the market narrow some? That's what happens when you overinvest. I'm not good, bad, or indifferent. If you start to see mid-sized businesses or smaller sized businesses grow earnings in a better economic environment or good economic environment, and those gaps start to close, then you'll unlock some of the value that exists in other parts of the market, which would be a healthy thing and probably a reasonable assessment for a reasonable view for 2025.
And so AI is a super interesting topic, right? Because you have those top companies that are spending so much capex right now, and they're putting so much money into that space. Nope, we have yet to really see return for that capital, right? That's probably a 2025, maybe 2026 story. Something that I really am going to be paying attention to is how that affects those other 490 plus names, right? So something that I that I really think could be a huge possibility is you're going to see these companies, their margins are most likely going to have pretty sizable expansion because, just think about a company who used to have to hire, a couple dozen people for something. Now they can just implement, an AI strategy or an AI technology, not have to hire any of those people. There's an initial outlay or monthly, service for that technology. And, that technology allows their margins to they don't have to hire those individuals, and the company can grow by margin expansion. That's
Great point.
something that, yeah, we probably, in my opinion, could see a lot of that going forward for the next couple of years.
Great point. It's very early innings
Yeah.
in this. Right now, the markets are rewarding the businesses that are going to provide the chips to make this happen, or the companies that have the software that allow this to happen. What you and I are both saying is that we haven't even thought about, or the market hasn't even begun to assess the downstream
Right.
impacts.
Right.
Right. I mean, you probably saw that study where they gave symptoms to top Ivy League doctors and to ChatGPT or whatever, and the AI was right 90% of the time, and the Ivy League doctors were correct 74% of the time. So,
Right.
I hope I got that right. I don't mean to insult anyone. I have nothing but respect for doctors, but you start to assess what that's going to mean, even in just the healthcare space, but so
Yep.
many other different parts of the U.S. economy and the global economy.
Yeah. No, healthcare is an extremely interesting one to see how that's going to play out going forward. Piggybacking on that, though, with the whole environment, that we're in, taking a step back to what we discussed previously, just about the setup going forward. What do you, from your point of view, right? How does investor mood affect how you think about the change of calendar, right? It seems you have a lot of you have a lot of strategists where even the ones that were the most bearish coming into this current year have completely changed positioning, and now they're on the other side of the boat. It just seems like everybody is sitting on that one side of the boat. They're expecting next year to be a good year. I'm not expecting it to be another 30% year like we've seen this year, and I that's certainly not consensus, but most everybody's expecting next the markets to continue to do well, and investor sentiment is pretty high. Does that how does that how does that play into your thought process?
Investor euphoria does give you tactical cause for pause a little bit, meaning that could this be a market that's ripe for some type of pullback at some point in 25? Yeah. Now, um, pullbacks don't come out of nowhere. They're almost always the result of policy uncertainty. So you identified one. Is it the Fed recalibrating where rates are going to be? Another one could be a lack of clarity around trade conflict or where tariffs are ultimately going to end. We saw that in 2018. I don't know how many people remember 2018, but by Christmas Eve 2018, the market was down 20% peak to trough. amid concerns about the trade war. So you could definitely have one of that. But what's critical is that that wasn't the end of the cycle, right? The markets continue to press higher. That was just a pullback, a policy-driven pullback. So when you get euphoric like this, there is the opportunity for some level of disappointment somewhere that causes the markets to gap down a bit. Usually they represent buying opportunities. I ask people, what's there not to like right now? Typically, peak inflation, which happened 2 years ago, peak tightening, which happened a year ago, peak interest rates, which happened some months ago, tends to favor stocks.
Yep.
And you can go back to the early 80s, you can go to the mid 90s. I mean, when these things tend to happen and the Fed starts to ease, you tend to get a nice intermediate term, if not longer, move in markets. So it's hard to look at the current picture and be, a 1 to 3 year bear, in my opinion.
Right. No, I totally agree with that. Um, the tariff situation is an interesting one, right?
Yeah.
Because on one hand, I think everybody in the back of their mind knows that he's partially not joking, right? When he makes these statements about tariffs, but then it does seem like everybody's kind of brushing it to the side, right, and saying that we're not going to experience the level of tariffs that he has suggested, right? So Mexico and Canada at 25%. He said some stuff about China, the BRICS countries, etc. You know, if we do see that inflation though, then that could have, or pardon me, if we do see those tariffs, that could have an effect on where inflation trends going forward.
Yeah, I would actually be more concerned about growth than inflation. I might be in the minority on
Right.
that. What we saw in 2018, if you had to go buy a washing machine or auto parts or whatever else we put tariffs on that year, the price of it obviously went up to you. Anyone that can pass that on is going to pass that on. And so the price to the consumer went up. So the basket of goods that had a tariff had a one-time jump. Started to level off before the pandemic, actually. The rest of the consumer price index didn't do all that much. And if you remember in 2019, the Fed was easing,
Hmm.
not
Right.
raising rates. Now, why were they easing? Because we had a growth scare. The challenge of the look, tariffs create a less optimal economic outcome, right? If somebody can make something cheaper than you can, you're better off if they do, right? Your standard of living improves. Now, there's reasons for tariffs if you want to protect industry, if you want to support communities. I'm not a politician. That's for the politicians to decide. You will get a less optimal economic outcome. Um, but a lot of it has to do with clarity. Like give
Hmm.
businesses clarity. If businesses don't know the rules of the game, things slow down. And
Right.
business investment really fell off a cliff in 2018. That's the risk we have. I think it's more on the growth side than the inflation side.
Yeah, that makes sense. I wouldn't disagree with that at all. Um, and it ties into what we've been saying with the consumer being in a good spot, right? If inflation goes up a little bit, it's not like they can't handle it. It's when you start to see these companies possibly do layoffs, when see people or companies spending less on certain product or spending less, that's where it could really have an effect. Um,
Yeah, so give us clarity. I think the market believes that, perhaps the Trump administration or Trump learned the lesson the first time. And, Trump certainly uses the broad market as a proxy for how the administration is going. So, perhaps the belief is that greater clarity will come quicker, will adjust to it, and then the focus will move back to tax cuts, deregulation, but but it is a little bit of a Rorschach test. You remember those Rorschach tests, the ink blot tests, where you see a sailboat, I see a bat, fruit
right.
bat or something. I mean, that's
Yep.
that's kind of the way it is right now
Yep.
with investors.
I just really think something that I keep coming back to is I think he's going to grade his presidency based off how the market performs during the next 4 years. Right. I think when he takes a step
Correct.
back after he's done, he's going to say to himself, "I did a good job." If the markets are substantially higher than they are today, and if they're
Yeah.
lower, then I think he'll say the opposite to himself.
Well, but there's more to it than who's in the executive branch.
Hmm.
Trump is walking into a good backdrop,
Right.
right? If you look at, think about when the markets have ever gone down during an administration, it doesn't happen all that often. The last one was George W. Bush, and clearly nobody wants the market to go down on their watch. Now, could W. Bush have solved a period where the Federal Reserve was tightening 04, 05, 06 at a time when the banks were lending too much money and packaging those loans and writing insurance on it? I mean, some of it just goes beyond what an administration can do.
Hmm.
Um, the reality is most presidents, 11 of the last 13 presidents, have experienced positive market returns, most of them double digit annual. So it wouldn't be out of the ordinary. What the interesting thing about Trump is walking into a good economy. Right now, I know Kamala Harris lost the election on it being a not good economy. A lot of that had to do with the cost of living. All right. And again, we can debate where that came from. I'm on the side that came from a pandemic, but the Republicans did a good job of pinning it to the Democrats. But if you think about what drives markets, Trump is walking into a very good backdrop, good growth and modest inflation. Now, um, pursuing some of those policy agendas could disrupt that. I would say, if all things being equal, if we didn't do much over the next 4 years, you're likely to have quite a good market.
Right.
Um, some of these things, I think tax cuts, deregulation should help. But to the extent that um, trade conflict persists for too long, again, we'll have a gap down in markets, at least in the near term, at least in a shorter
Yeah.
period. But I still
Yeah.
think markets will finish positive.
Yeah. I mean, it speaks to the idea of how strong the 500 companies in the S&P are, right? It's I've heard them referred to as 500 Michael Jordans, right?
And how
So,
strong the economy is, and and
yeah,
and whether look, if the Fed has to raise rates, valuations adjust regardless of how strong the companies are, regardless of how good the president or is. If the economy rolls over, earnings roll over, right? All of that happen. I mean, we have cycles.
yeah,
We haven't killed cycles. Donald Trump hasn't killed cycles. Joe Biden didn't kill cycles, right? We have cycles, and so your starting point matters. And we look at people who had great starting points: Reagan, Obama. Biden had a fabulous starting point coming out of
yeah,
recession. What's better
right,
than that?
yep,
Right? Trump's isn't as good as that, but seems pretty good.
right,
So, that seems like a pretty good starting point.
yep. So with everything, you know, trending well on our side here at the U.S., what are your thoughts, going overseas? Um, if you look at the spread between, the prices of U.S. securities and international, they're at a pretty far spread. Um, one thing that I think is really important to always consider, though, is the fact that most likely it always will be at some sort of spread, right? The U.S. always will be more expensive than the rest of the world, unless something dramatically changes here, right? We're the center of innovation, the center of entrepreneurship. We have the best companies in the world domiciled here. So that always should persist. But, speaking from, a portfolio positioning standpoint, right, international should have a place in a portfolio. It's underperformed recently. We've had a lot of conflicts going on overseas, some different economic situations. But what do you think about, the international landscape going into next year?
Yeah, international requires a catalyst. Usually that catalyst comes from rising growth globally, right? They tend to be more cyclical in nature than the US, or you were suggesting great businesses that are, more growthy, structural in nature. And they've been challenged. They need the dollar to break its, what has been a 15-year advance, if not
Hmm.
more. And so, what if the Fed starts to lower rates more quickly, that does tend to start to break the dollar cycle. Doesn't mean the dollar's collapsing, but if the
Mhm.
rate differential between the U.S. and the rest of the world starts to go down, the dollar will weaken. That's been a little bit of a challenge right now because the rest of the world is easing and the Fed's on hold, or the Fed's going to cut one and then be on hold. So we'll see, but usually that helps. And then what you're starting to get now is what that entails is coordinated easing around the world. So places like China and places like the European Union that have had challenged economic environments are starting to provide some stimulus. So
Mhm.
when you're undervalued, you don't need things to be great for your markets to do well. You need things to get somewhat better. And maybe that's the best news we could say about the international markets. They just need things to get a bit better, meaning the stimulus starts to work, the Fed lowers rates, I think you'll see some of that. I mean, going into the year right now, Europe's still struggling a little bit. We're waiting to see enough China stimulus. The Fed probably is going to keep rates higher, so it might not be immediate, but over the next, couple of years, if, as things start to get a little bit better, I think you'll see some catch-up performance in those other parts of the world.
Yeah, totally makes sense, and that's historically what we've seen. I know, you hear CEOs of you know like Masayoshi Son was saying he's going to come, maybe deploy, 100 billion of capital in the U.S. That could have gone into his own country, right? And that's something that's super interesting to me, something that I paid attention to. And we'll see what happens with that when he meets with Trump. I believe that's sometime this week. Um, all right, so one thing I touched on during the intro that you're actively involved in with Invesco, is the compelling wealth management conversations, and that's something that you author, and you play a big role in that. So within that, there's 5 core principles, that you guys refer to in those those conversations. I want to quickly, we can touch on both those, before we can touch on all of them before we finish up. And I think the first one ties into something that we've discussed here. Actually, all of them tie into our conversation in some way. The first one is don't get distracted by news headlines. Would love to hear
Absolutely.
you. Yeah, would love to hear you, elaborate on that a little further.
I mean, one of the great quotes I've ever heard in this industry, again, coming back to Warren Buffett, he wrote an op-ed in the New York Times in October '08 during the financial crisis. And he said something like in the 20th century, we've had 2 world wars, a dozen or so recessions, financial panics, oil shocks, flu epidemic, resignation of a president, named a whole bunch of things. And the Dow went from 40 to 11,000. So, that's been my North Star. Don't get too caught up. We have a 24-hour, 7 days a week news cycle that is designed to drive you to watch more news.
Yep.
And so, if people are talking about drones in New Jersey, they're going to have more and more stories about drones in New Jersey.
Right.
And so, talking about as someone that lives in the New Jersey suburbs, so they try to keep us concerned. I mean, even
Hmm.
think of the last couple of years, we've had great markets with Russia and Ukraine, war in the Middle East. We had a presidential election. I mean, we've had so many different things that were so worrisome to people, and yet the market continues its advance. I tell people focus on the direction of the economy, focus on what the Fed's going to do. If all these other things don't change those 2 things, ignore it from the perspective of your portfolio.
Yep. We we give clients the same message, and it's super interesting to, when you actually read the headlines, and you go through, whatever publication you want, go whatever media outlet you want. There's headlines in there today that are built up to be something super important, and then once the clock turns to the next day, they're never spoken of again.
Yeah,
Yeah, so it's
that's the
yeah.
it's the old saying, what you're thinking about right now is not as important as you think it is. And
Yep.
that can go with just about anything in your life. I tell my kids that all the time.
Yep. 100%. Second principle is timing the market rarely works. It's this one to me is maybe the most important, right? Because as we mentioned in the discussion earlier, Market, PE wise, could be pretty high. Even if you just say, market's at all-time highs, I'm going to wait for a pullback, right? Doesn't always work out like that.
Doesn't
Um,
work out that way like that.
yeah, dive
Actually,
into it a
if you
little
look
more.
historically, you've been better off investing on market highs than any other day,
Yep.
which is just stunning, I think, to most people. In fact, the S&P 500 went live in 1957. There's been a new high once every 15 or 16 days on average, which is right. So that tells you a lot of what you need to know. I mean, this thing about timing the markets, yeah, it's this idea. People think that they have a unique ability to do something that's been proven time and again to be a challenge. And the reason why it's a challenge is because by the time things are bad, the market has largely priced it. When things start to get better, investors tend to still be upset that things are bad.
Yep.
So, and or not perfect. And I mean, you could think of that out of COVID, right? I mean, how many people were saying in May and June of 2020, how could the market be up if the economy's so bad? And it was, well, this is a market that is excited about low interest rates, a lot of stimulus, and some expectation that human ingenuity, i.e., vaccines or whatever else, will get us
Hmm.
out of it. Things were slowly getting better, right? They got terrible all in 10 days. And by the time people wanted out, they started to get a little bit better. Even if you were still quarantining in your house, they were getting better,
It's forward
right?
looking.
And
Yep.
so it's forward looking. What ends up happening is people try to miss the worst days in the market. But the
Right.
problem is the best days in the market almost always happen right next to the worst day. So if you think of, I think it was March 22nd or March 24th, 2020, I can't remember the exact day, the market was up 9%. That's a
Yeah.
full year's return in
Yeah.
one day.
Face
And
ripper.
that was the week everybody was piling out of markets. You miss a day like that, your returns are really, really impaired over time. If you look at the 30 best days in the last 30 years, 80% of them happened during the tech wreck, during the global financial crisis, or during COVID,
Wow.
right? And so,
Interesting.
how can you time that? It's almost impossible.
Yeah. You just listed off, a few stats right there that are just mind-boggling. The one I like the most was the new high in about every 15 days in the S&P.
Yeah.
That's
I mean,
that
I think
that's
how many have
that's
we had?
wild.
I think we've had 60 this year or close to it,
It's up there. Yeah.
somewhere right around there. Yeah. I mean, so how many
Yeah.
trading days do you have in a year? 250,
Yep.
right? So that's 20, what, 25% of the days close to that this year.
Yep.
We had a new high.
Hmm.
Yeah. I mean, it's pretty
And it's
wild.
when you think about putting money to work, though, it can really frustrate you, right? That stat can really frustrate you if you're like, okay, you have a client walked in the door today, want to put some more money to work, but the market's made, you know, 20 new highs so far this year, right? And I'm just, just using those numbers. I'm gonna wait for, a little pullback, wait for us to basically not be, going straight up in a line, and then it never happens,
It
right?
gets
Then
away from you.
20 goes to 30, 30 goes to 40, etc. Yeah.
It could get away from you. And I think the problem people have is then if the correction happens, how do you know the correction's done? Right. If you think about, was it beginning of August or beginning of September, the market was down 8.5% or so
Mhm.
this year. And
Yep.
the most media pundits, people such as myself, attribute it to the uncertainty around the yen carry trade, right? And so if you were sitting on cash, market was probably what, I don't know, 5,800 or wherever you were around there. You go down 8%. All right, this thing's going down 20. It didn't. Now you're over 6,000, right? It's how do you time that? How, things are going bad over a 4-day period. How do you say, okay, now I'm in,
Hmm.
right? Or what has to happen for you to say, okay, I'm in? I can
Right.
assure you during COVID, when markets were down 35%, there weren't a lot of people saying, okay, now I'm in.
Right. And there's always something to keep you on the sideline, right? If you
There's
want to,
always something.
right? You
I
referenced the yen carry trade, but there's always something you can think of.
there's always something. And drawdowns are always going to be policy driven, so we shouldn't expect perfect policy clarity our whole lives. And you have cycles. I mean, there's recessions. Thing is that, investors have gotten to believe that recessions mean 50% downturns because that's been our last couple of experiences. I mean, you can have minor recessions where the stock market goes down 20%, you recover in a year historically on average. So, yeah, people are waiting for the shoe to drop. Um, it's in 100 something years that shoe hasn't even the Great Depression, ultimately you recovered from it once you got a better policy mix. And, one would hope we've learned a thing or two about policy since the Great Depression.
Yeah, and the shoe's always changing, right? It's you know it during COVID, the market was down 35% or so, and by all historical standards, it was a great time to get cash off the sidelines and become a participant. But you could have thought of a trillion things back then that
Oh yeah.
you were just waiting for
And
the next
since
thing to
then,
happen. And yeah, yep.
Michael, if I'd said to you 30 years ago that in the next 30 years, technology stocks are going to go down 50 to 80%. You're going to have a terror attack in the US that leads to multiple wars. You're going to have the worst global financial crisis in a century. Britain's going to leave the European Union. You're going to have the worst pandemic we've seen in 100 years. Would you think the market's up 12% per year for the last
Wow.
30 years?
Yeah.
Right? I mean, there's,
Yeah.
in 12% a year, I mean, the rule of 72, it's doubling your money every, what, 6 years or so?
Yep.
Right? I mean, I don't know if it's exactly 12, but you get my point, right? I
Right.
mean, it's just been a stunning advance in markets in spite of all of that, because you have to ask yourself, in the last 30 years, have things gotten better? Again, not good or bad. My life's gotten better in the last 30 years. Well, I wish I was in high school again, but you know what I mean? Like in terms of like having I have a
Yeah.
computer in my pocket, right?
Right.
For starters, that I carry with me everywhere, right? You can't tell me, there more people are more literate. People tend to live longer. They're healthier. Right. So many things have happened in the last 15 years. 15 years ago, we didn't have cloud computing. We didn't have 3D printing. We didn't have autonomous vehicles. We didn't have virtual meeting software. We didn't have gene editing. We didn't have artificial intelligence, right? Things get better, and that's what markets reflect, right? The fact that we had a pandemic, or the fact that Britain left the Eurozone, um, that doesn't stop cloud computing from happening, right? It doesn't stop artificial intelligence from happening. That's what matters. The innovation, the advancements, the ingenuity, that's what matters.
Yep. And it all compounds on itself.
It all compounds on itself.
Yeah.
You would ask me what's the, offline, you would ask me what's the thing I learned in this industry that I've taken with me. I mean, one of the first things one of the brighter people in this industry told me is that pessimists sound smart,
Yep.
but optimists tend to make money. And he said it bolder than that: pessimists sound smart, optimists make money. And that's, I've always used that as a North Star.
Yeah. The bears always sound the smartest. All right. Uh, Next principle: following the herd can be a bad investment strategy. Ties exactly into what we've been
Yeah,
talking
just
about today.
Yeah, just be mindful. I mean, just
Yeah.
because as soon as everybody's making money on something, you're probably late.
Yep.
Or as
Yep.
soon as everybody's jumping ship, you're probably late.
Yep. All right. Fourth one: market highs are nothing to fear.
Yep,
Had
talked
60 of
about
them or
it.
so this year. Yep. Uh, and then we'll finish up on the last one. I think it's super great. There's never a bad time to invest for the long term. Right. That's something that,
No,
yeah, ties into financial education, financial literacy, and that's just a core principle of everything that we do as financial planners and what you do as a strategist.
yeah, and I like to think back to October '87, to think of it as an example. I was 11 years old, and I remember my father. I didn't know exactly what was going on, but my father coming home and saying that we had lost 25% of our net worth that day. And, I got to thinking years later, I mean, imagine if you inherited $100,000 on the eve of that. So the Friday night, and then you invested it that Friday, and by the end of day Monday, it was worth $75,000. I mean, could you imagine the pain you would have felt if you did nothing? Today, it's like $3 million, right? I mean, so So you would say that's the absolute worst time to invest, right? We never before. I don't think we've had a 25% day in a century, right? Besides that one. Um, so that was the absolute worst time to invest. And
Mhm.
40 years later, or close to 40 years later, you're $3 million on $100,000 investment. So that's exactly where that line comes from.
That's awesome. It's awesome. It's I always love to hear about. I always love to hear stats like that. You know, if you put, do it. People do it with individual companies. You can do it with sectors. You can do it with the market as a whole. But it's a guilty pleasure of mine. I
I
like to.
enjoy it too.
Yeah, it's funny. Um, all
I
right, so
like
Brian, that's what.
charts.
Yeah, that's what we'll finish up with. And I was going to ask you that question about what the most important thing, or one of the things that stuck with you, throughout your career. Um,
That's it.
but you beat me to it.
Yeah, that's it. I mean, I saw the clock winding down and I said, oh, I better get to this. I thought about it for you.
Yeah. No, I appreciate that. It's been a pleasure to have
My
you.
pleasure. It's been
When
mine
when
as well.
you're
Thank you.
awesome. When you're up in the Northeast next year, we'll have to get together in person and talk markets again. It's been great. Greatly appreciate you taking the time. Thank you so much. And
My pleasure.
everybody,
Thank you.
of course, of course. To everybody out there, thank you so much for tuning in. This is Sharpe Minds episode 2. We have frequent uploads coming, especially early next year. Keep an eye out for everything that's to come, and make sure to like, subscribe, and follow us on social platforms, and greatly appreciate the support. Thank you again, Brian, and we'll talk to y'all soon.
Sharpe Minds is produced and hosted by Michael Lafata and directed and edited by Alex Weimer. Our music is made by Tony Sapiato and licensed through Soundstripe. Michael Lafata, Financial Advisor, Archstone Financial, 508-453-9800, 324 Grove Street, Worcester, Massachusetts, 01605. Securities and advisory services are offered through Cetera Advisor Networks LLC, member FINRA, SIPC, a broker, dealer, and registered investment advisor. Cetera is under separate ownership from any other named entity. Archstone Financial is not a subsidiary nor controlled by Cetera Wealth Partners. The views stated in this podcast are not necessarily the opinion of Cetera Advisor Networks LLC and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Due to volatility within the markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable. However, their accuracy or completeness cannot be guaranteed. Past performance does not guarantee future results. The guest speaker interviewed in this podcast is not affiliated with or registered with Cetera Advisor Networks LLC. Any information provided by them is in no way related to Cetera Advisor Networks LLC or its registered representatives. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Asset allocation is an investment strategy that will not guarantee a profit or protect you from loss. Exchange-traded funds and mutual funds are sold only by prospectus. Please consider the investment objectives, risks, charges, and expenses carefully before investing. The prospectus contains this and other information about the investment company can be obtained from your financial professional. Be sure to read the prospectus carefully before deciding whether to invest.